Hey there, thanks for tuning in. Welcome to Investing in Germany, and today let's have a quick look at the inflation in Germany. For the first time in the last 1.5 years, the inflation in the EU has cooled down. So at the moment at EU level, we have an inflation rate of about 10% on a year-on-year basis. And this is a good news because the inflation has cooled down since the October, where it had a peak of 10.6%. This is the same as well for the Germany, where the inflation is currently stands at 10% in November 2022, comparing it to a peak of 10.4 in October 2022. So this is a good news for all the monetary policy makers. Don't forget that the target inflation rate for the European Union as well as for the Germany is 2%. We are still 5 times the target inflation rate. So there's a long way to go. So we have to sit tight. The only question here is, to which nobody has an answer, is whether this is a one-off impact that we are seeing in the inflation or this is a structural decline in the inflation. So we have to wait and watch how the next couple of months and quarters goes on, and then we can come to a conclusion whether this is a one-off or this is a structural change in the inflation going forward. ECB is still confident to bring down the inflation to 2% by 2024-2025. So let's see how it progresses, because there is still a lot of uncertainties like the energy crisis and so on. On the November 28, 2022, the Christine Lagarde, the president of the European Central Bank, said that she'll be surprised to see if the Eurozone inflation had peaked. Maybe she has some data points to cover this, which the market does not have at the moment. For now, if we think the inflation is behind us, then we are fooling ourselves. As you can see, there is no structural trend data available. As explained in one of my last videos, there is a strong relation between the inflation and the unemployment. So let's have a look at the unemployment. The unemployment in Germany has inched up a bit, so this is a really good news for the monetary policy makers. On the other hand, we also have a strong employment market in Germany. There are literally too many job openings but not enough people to work on. So recently, the Germany has also proposed to change the immigration rule to attract talents around the world with less paperwork and approval processes. In this proposal, anyone can come to Germany with a valid employment contract and evidence of meeting a point system like in Canada and Australia. So there is a really good trend going on in the labor market. So let's zoom out from a bit from the Germany into the European Union. The inflation in the Baltic countries are still at a really extremely high level, but slowly coming down. Lithuania is now extremely affected by the Russian war on Ukraine and also by poking the Chinese. Since the Taiwan opened its trade office in Lithuania, the China has blocked the import of beef from Lithuania. This looks like some sort of a trade war going on between Lithuania and the Chinese. I hope that this does not spill over to European countries. As the inflation cooled down last month, some economists in the ECB board are voting to reduce the pace of the interest rate hike. As you will remember, ECB had increased the interest rate at 75 basis points in the last two meetings, and the economists are voting for a 50 basis points. They are really worried about the deep recession if the rate of interest rate hike is at 75 basis points. Market is really happy to see the slowdown in the inflation. As you can see by the DAX performance, it has moved significantly up between the 30th of November and 1st December when the inflation rate came down. So this really shows that the market is really cheering up this downward trend in the inflation. On the other hand, we also have the euro gaining some strength compared to the US dollar, so this also really helped in bringing down the inflation. And finally, the crude oil is also really stabilized around 80 to 90 range, comparing it to the peak where it went up to $120 as soon as the war started. So this is really a good news, and these are all really gave a positive trend to the inflation rate in Germany as well as in the EU. From the 1st December 2022, the European Union ban on seaborne oil imports from Russia is in effect. Russia will still keep selling its oil to India, China. We in Germany now are facing the cold winter and high energy cost. The EU has set up a price cap of Russian oil to be at $60 recently. The idea here is that the cap will be too low, that Russia will not be able to make money from its crude oil export. Therefore, Russia has less money to fund the war. This will eventually then push Russia to a corner, and then they will retreat. This is not going to really happen at the moment based on this price trend, because the $60, the cap which the European Union has put in, is way too high compared to what the Russian grade oil is trading around the market, which is around $50. So there is a delta of $10, which Russian will be really happy to have it in their portfolio. If you also compare the $60 to the average of the Russian oil in the past 5 years or so, the Russian oil is always traded at around $60, so there is not a really impact to the Russian economy because of this price cap. I just don't get this at all. And also don't forget to read between the lines. The price is only for the seaborne shipments and not to the oil import through the pipes. As you know, Russia is also supplying oil through the pipes to the EU, and there is no price cap there. I just don't get this at all. The EU for sure needs Russian oil. This is for sure, and you can see this in the price cap joke. And we have another joke called LNG, the liquefied natural gas. The EU countries are buying the LNG like there is no tomorrow, and there is absolutely no restrictions to the Russian LNG. Russia is not yet pushed to a corner by all these sanctions. With this data, I can only say that it's just a political drama, nothing sort of bringing down the Russian economy to stop the war. So we can see here France, for example, compared to 2021 to 2022, has almost doubled their import in LNG from Russia, Spain as well, Belgium as well. So there is no real pressure to Russia because Russia is earning a lot of money by exporting the oils and the LNGs to the European Union and also to the rest of the world. Another major reason for the inflation in the European Union is also the zero COVID policy in China. So China is slowly coming out of zero COVID policy. The Chinese news agency reported recently that the PCR testing should be executed based on the situation rather than the better model. In other words, the mass testing and the mass quarantine will be less frequent, so no high-scale lockdown until something really goes out of hand. Even the PCR testing booths in Beijing are being reduced. This clearly shows a shift in the policy in the China. This shift should help in reducing the supply chain stress. The market is really happy to see these developments, which you can see here, the spikes of the Chinese stocks. This positive news for sure coming from the Chinese economy should help us to bring down the inflation rate moving forward. Another big news is the Germany's biggest labor union has secured a 5.2% increase in wage in June 2023 and a 3.3% increase in 2024, and also a tax-free bonus up to 3,000 euros. So this will for sure create a demand in the market and thereby increasing the inflation, but luckily this has been stretched out for more than a year, so there will not be a sudden increase in demand. We have to see how this excess liquidity in our pockets is going to bring the inflation up, so this is something for us to wait and watch. From the liquidity point of view, we have a really big elephant in the room, which everyone almost forgot, but of course not me: the quantitative tightening. As you can see here, this excess liquidity which the central banks and the politicians printed quickly to solve the liquidity crunch due to the economic shocks like the financial crisis and the corona pandemic, this liquidity will slowly be removed from the market. Christine Lagarde, the president of ECB, on her last meet at ECB policy, said that the policymakers will start discussing about the quantitative tightening and they will plan a draft on how to execute this. This is a delicate matter for the ECB because this is a new territory for ECB. It has never done a quantitative tightening. Like the Americans, they started quantitative tightening and then they stopped it due to the corona pandemic. But here for ECB, this is quite new. And I believe that ECB does not have any clue how this will affect the individual economies within the euro area. So if you remember from my other videos, we have Spain, Italy with a high level of unemployment compared to Germany. So where the ECB will start the tightening is something that we have to wait and watch. As you can see here, the liquidity and the S&P 500 index are moving in tandem. So once the liquidity is dried up, the S&P 500 will revert back, which will be very low stock prices and also market prices. So from the stock market perspective, we will have one major volatility or crash or dip, whatever you want to say, in the first half of 2023, as soon as the clarity emerges on the quantitative tightening by the Fed as well as by the European Union and also the other economies around the world, because there's a lot of liquidity around the world and almost all the economies are facing the heat of inflation and everybody are now talking to bring down this liquidity from the market so that the inflation is controlled. This is once in a decade opportunity to be in the market because we can really get the quality businesses at really cheap prices compared to the value. So start preparing yourself to enter the market next year. I'm already started preparing. So sit tight, enjoy the ride. See you in the next video.